Okay, so let's talk about building wealth. Most of us, right, we're taught it's this slow, steady, straight line. You just put money in, it grows a little, and you just do that over and over for like 40 years. But what if that whole idea is just wrong? Well, that's exactly what we're going to dig into today. We're going to challenge that assumption completely.
See, the reality is wealth doesn't grow in a straight line. Not at all. When you actually look at the math of compounding, it shows you there's this specific rhythm to it. It's not linear. It's a pattern that starts out feeling painfully slow, and then all of a sudden, it becomes explosively fast. And yeah, this pattern actually has a name. It's called the 8-4-3 rule. The best way to think about it is as a mental model for investing. It basically shows you that the growth it takes 8 years to get at the beginning, well, you're going to repeat that same amount of growth in the next 4 years. And then you're going to do it again in just the next 3. Understanding this timeline, man, it's so key. It's what keeps you from quitting right before all the magic happens. So this whole 15-year journey, it really breaks down into 3 super distinct phases, and they're almost psychological phases. First up, you've got the grind. Then things start to pick up in the acceleration, and finally, you hit the leap. So let's break down exactly what's going on in each one of these phases. All right, phase 1, the first 8 years. Welcome to the grind. And let me tell you, this is where most people give up. It honestly feels like you're pouring water into a bucket that has a hole in it. The growth is it's so slow, it's painful, and it's going to test your patience more than just about anything else. And this right here, this perfectly shows you why it feels that way. Think about the workload. In these early years, you are doing all the heavy lifting. You're the one carrying the couches. And the market? The market is like that friend who promises to help you move, but then shows up and just carries like one lamp. That's why it feels like you're getting absolutely nowhere. So the most important thing here is to kind of reframe your goal for this phase. Look, you're not investing for big returns yet. That's not the point. You are investing to build what's called critical mass. You're essentially packing the snowball together, right? Making it bigger and denser so that eventually it can start rolling downhill all by itself.
Okay, so now let's talk about phase 2. The acceleration. This is from year 9 to year 12. And this is where things finally start to feel different. The market, your friend, stops carrying those little lamps and actually shows up with a moving truck. It becomes a real partner in building your wealth.
And the math here is it's incredible. Think about it. It took you 96 months of grinding to build that first big block of wealth. Now, here in phase 2, it only takes you 48 months to build the exact same amount all over again. Your speed has literally doubled. This is that magic point where your returns start making their own returns, and that snowball really starts to pick up speed.
And that brings us to the grand finale, phase 3, the vertical leap. Now, this only covers 3 years, years 13, 14, and 15. This is where that compounding curve goes from just being steep to looking like a hockey stick. Our brains, they think in straight lines, so we're not really built to grasp this. It feels like magic, but it's not. It's just math. Math that you had to earn. Yeah, the rate of growth here it's almost surreal. In just these 3 years, your portfolio builds another chunk of wealth that's equal to what you made in the last 4 years, which, if you remember, was equal to what you built in the first 8 years. It gets crazy. You might have days where a simple 1% market swing adds more money to your account than your entire monthly paycheck.
And this is why cashing out early is just devastating. It illustrates it perfectly. If you stop at year 10 or year 12 to buy a new boat or something, you're not just spending your money. You are killing the exponential phase. It's like you're chopping down a tree that you spent a decade watering right before it was about to give you all its fruit.
All right, let's put some actual numbers to this. Let's say you invest $500 a month. Okay, after 8 years, you've put in $48,000, and your balance is maybe around $75,000. Not bad, right? But just wait. Look what happens next. In just 4 more years, it jumps all the way up to $140,000. And then in those final 3 years, it surges past $200,000. You're putting in the same amount of money, but the results just get bigger and faster over time.
And this chart here just makes it crystal clear. You're gaining about the same amount of wealth in those 4 years of phase 2, and then again in the 3 years of phase 3, as you did in the entire first 8 years combined. It's amazing. Your time just becomes exponentially more powerful the longer you can stay in the game.
Okay, so what's the big takeaway here? What do we actually do with this knowledge?
How does understanding this whole 843 rule change the way we act? Well, let's turn this theory into a super simple, actionable plan.
Well, first off, it completely changes your mindset. You stop looking for those get-rich-quick lottery tickets and you start looking for a shovel. It makes you realize that building real wealth is a 15-year project, and that makes starting right now absolutely non-negotiable. It also totally reframes how you think about market crashes. In those first 8 years, a crash isn't scary, it's just a discount. It's a chance to buy more of your investment on sale.
But you have to be careful. There are two things that can completely wreck this entire process. The first one, high fees. A 2% management fee. I mean, it sounds so small, right? But it's like dragging a heavy anchor behind your speedboat. It just flattens out that beautiful growth curve. And the second killer is your own behavior. Interrupting the machine because you get scared or you get greedy, that is the ultimate mistake.
So here's your 4-step plan. It's simple. Step 1, pick a goal. Name it. Is it retirement? Freedom fund? Give the money a purpose. Step 2, automate your contributions. Just set it and forget it. Treat it like a tax you're paying to your future self. Step 3, pick the right vehicle. A simple, low-cost global index fund is a great choice. And step 4, this is the hardest part, commit. You have to promise yourself you will not interrupt the machine. Because ultimately, that's the whole game right there. Once you've set up the system, your job is not to be some brilliant stock-picking genius. Nope. Your job is to be boring. Your only job is to manage your own impulses and just let the system do its thing for 15 years straight.
I absolutely love this analogy. Investing is like a marathon where they only give out the medals at the finish line, at mile 26. If you stop at mile 20 just because you're tired, you don't get a smaller prize. You get nothing, just sore legs. You have to finish the race to actually win.
And really, here's the final takeaway. All the hard work, all that sacrifice, all the psychological pain, it's all front-loaded into those first 8 years. But all the really life-changing rewards, they're all backloaded into those final 3 to 5 years. Your entire job is just to survive the grind so you can be there to enjoy the leap.
You know, this is why the rich seem to get richer so effortlessly. It's because they've already survived their early phases. They now live permanently in that acceleration stage. They've got the capital, and more importantly, they've got the patience to get to year 15 and year 20 and beyond. So the only question left is, do you?